Hello everyone, welcome to the market opening bell on Wednesday, April 1st, your 10-minute guide to the stock market. Yesterday was the end of the first quarter for Hong Kong stocks. The market continued to focus on the situation in the Middle East and Hong Kong stocks fluctuated. The Hang Seng Index opened 67 points higher, rose as much as 237 points to 24,988 in the early session before pulling back. In the afternoon, it turned lower by 191 points to 24,559. It eventually closed up 37 points or 0.2% at 24,788. The H-share index fell 24 points or 0.3% to close at 8,374. The Hang Seng Tech Index dropped 40 points or 0.9% to close at 4,649. Total market turnover for the day was 255.7 billion Hong Kong dollars, with Southbound trading at 108.9 billion dollars. Southbound funds recorded a net inflow of 703 million dollars into Hong Kong stocks. Among them, net buying included Xiaomi at 911 million and Tencent at 431 million. Net selling included Tracker Fund at 2.98 billion, CNOOC at 1.282 billion, CSOP Hang Seng Tech ETF at 760 million, SMIC at 438 million, and Alibaba at 327 million. According to statistics, Southbound funds have been net sellers of SMIC for 12 consecutive days, totaling $5.451 billion. They have also been net sellers of Alibaba for 4 consecutive days, totaling $2.856 billion, while being net buyers of Tencent for 4 consecutive days, totaling $1.601 billion. From a technical perspective, the Hang Seng Index faced resistance near 25,000 points but found support near 24,500 points. Is expected to continue fluctuating within this range in the short term. Hong Kong stocks officially closed trading for March yesterday. This month's performance continued to be affected by the US-Iran war, with subdued market sentiment. The 3 major indexes generally showed a downward trend and all hit new stage lows during the period. The Hang Seng Index fell 6.9% for the month, losing the 25,000 point mark. The H-share index dropped 5.5%, while the Hang Seng Tech Index fell sharply by 9.5%, performing the weakest. Southbound funds recorded a net inflow of 61.4 billion Hong Kong dollars in March. For the first quarter, the Hang Seng Index fell a total of 842 points or 3.3%. The H-share index dropped 539 points or 6.1%. The Hang Seng Tech Index plunged 866 points or 15.7%. Southbound funds posted a net inflow of 220.9 billion Hong Kong dollars in the first quarter. In terms of sectors, the lithium battery sector led gains in March. Contemporary Amperex Technology (CATL) surged 23.7% and hit multiple new all-time highs. CALB rose nearly 22%, coming in second. Auto stocks, mainland bank stocks, coal stocks, and optical communication stocks were mostly active. Geely Automobile jumped 29.5%, BYD rose 11.4%, and NIL gained 10.8%. In addition, CITIC Bank rose 9.6%, Bank of China gained over 7%, Industrial and Commercial Bank of China rose over 6%, and China Construction Bank increased 5%, all reaching new historical highs. On the other hand, the gold sector saw larger declines. Non-ferrous metals such as copper fell across the board, and the semiconductor sector recorded noticeable drops. Among large-cap tech stocks, Kuaishou plunged more than 28%, Alibaba fell 16.7%, Baidu dropped 14.6%, Xiaomi declined 9%, Tencent fell 6.6%, and NetEase dropped 3.9%. Only JD.com bucked the trend with an 8.4% gain, while Meituan rose 2.2%. The three major A-share indexes performed weakly. The Shanghai Composite Index fell 31 points or 0.8% to close at 3,891 points. The Shenzhen Component Index dropped 248 points or 1.8% to 13,478 points. The Chinex Index declined 88 points or 2.7% to 3,184 points. Combined turnover in Shanghai and Shenzhen markets total 1.99 trillion yuan. For the whole month, the Shanghai Composite Index fell 6.5%. The Shenzhen Component Index dropped 7.1% and the Chinex Index declined 5.1%. The renminbi central parity rate against the US dollar stood at 6.9194, up 29 basis points from the previous day. China's National Bureau of Statistics announced that the March manufacturing PMI rose to 50.4, higher than the market expectation of 50.1 and significantly better than the previous month's 49, returning to expansion zone. This indicates a rebound in manufacturing activity after consecutive contraction. The data showed that strong overseas demand coupled with stable capacity utilization effectively supported industrial production levels and became the main driving force behind the manufacturing recovery. Amid gradual adjustments in global supply chains, China's export-related industries still demonstrated certain resilience. In the non-manufacturing sector, the March PMI rebounded to 50.1, also higher than the market expectation of 49.9 and notably improved from the previous month's 49.5. It marked the first return to the expansion zone since December last year, signaling signs of recovery in service sector and domestic demand activities, supported by the government's ongoing stimulus policies. Overall, the March PMI data suggests that the Chinese economy has shown improvement after a weak start to the year, with both manufacturing and services warming up in tandem, which should help stabilize full-year growth expectations. However, the market remains concerned about whether the subsequent recovery momentum will be sustainable, especially given the persistent uncertainties in the external environment. Attention will next turn to the private PMI data to be released on Wednesday for a more comprehensive assessment of China's actual economic conditions. The Monetary Policy Committee of the People's Bank of China held its first quarter regular meeting for 2026 earlier. The meeting noted that since the beginning of this year, macro policies have become more proactive and effective. Monetary policy has remained moderately accommodative, strengthening counter-cyclical and cross-cyclical adjustments while comprehensively utilizing various monetary policy tools to create a suitable monetary and financial environment for sustained economic improvement. The meeting observed that changes in the external environment have deepened with weak global economic momentum, frequent geopolitical and trade conflicts, divergent economic performance among major economies, and uncertainties in inflation trends and monetary policy adjustments. China's economy has operated steadily overall with steady progress, achieving new results in high-quality development. However, it still faces challenges such as strong supply versus weak demand and external shocks. It is necessary to continue implementing a moderately accommodative monetary policy, intensify counter-cyclical and cross-cyclical adjustments, better leverage the dual functions of monetary policy tools in terms of aggregate and structure, strengthen coordination between monetary and fiscal policies, and promote steady economic growth and a reasonable recovery in prices. From a technical perspective, the Hang Seng Index remained capped by the 25,000-point resistance level yesterday. However, with the market hoping that the Iran war will come to an end and US stocks staging a strong rebound on Tuesday, the Hang Seng Index is expected to retest the 25,000-point level and even challenge the 250-day moving average at 25,128 points. If it successfully breaks above the 250-day moving average, the next resistance level would be around 25,400 points. The market is hoping that the Iran war will soon come to an end. On Tuesday, US stocks staged a strong rebound. The fear gauge VIX index fell 5.4 points or 17.5% to 25.25. The Nasdaq index closed up 795 points or 3.8% at 21,590 points. The S&P 500 rose 184 points or 2.9% to close at 6,528 points. The Dow Jones Industrial Average also gained 1,125 points or 2.5% to close at 46,341 points. The Nasdaq China Golden Dragon Index, which reflects the performance of Chinese concept stocks, rose 183 points or 2.8% to close at 6,753 points. With the prospect of the war ending, the global travel industry is expected to recover. United Airlines and Carnival Cruise both surged around 8%. Nvidia plans to invest $2 billion in Marvell. Marvell's share price jumped 13%, while Nvidia rose 5.6%. Microsoft's stock price rebounded along with the broader market, closing up 3.1%, its largest single-day gain since July. However, due to concerns over AI prospects, the stock has fallen 23% in the first quarter of this year, marking its biggest quarterly decline since the 2008 financial crisis. This far exceeds the performance of other tech peers and the Nasdaq 7% drop. After the market closed, Nike reported its third fiscal quarter results ended February this year. Net profit fell 35% year-on-year to $520 million, with earnings per share at 35 US cents, beating market expectations of 28 US cents. Revenue came in at $11.28 billion, slightly above the expected $11.24 billion. North American revenue continued to grow steadily, rising 3% to $5.03 billion, though it was marginally below the expectations of $5.04 billion. Greater China, a region that has underperformed for the company in recent quarters, saw revenue decline 7% to $1.62 billion, but this was still higher than the expected $1.5 billion. Overall gross margin slipped 1.3 percentage points to 40.2%. The company attributed the decline mainly to higher tariffs in North America. The stock fell about 3% in after-hours trading. Data from the U.S. Bureau of Labor Statistics showed that job openings in the United States declined by 358,000 in February to 6.882 million, below the market expectation of 6.92 million. The Conference Board's preliminary reading indicated that the U.S. Consumer Confidence Index rose 0.8 points in March to 91.8 from 91 in February. Overall confidence saw a slight improvement for the second consecutive months. However, since 2021, the index has been on a general downward trend. Brent crude oil for May delivery surged 63% in March, recording the largest monthly gain since 1988. New York crude oil for May rose about 51% in March, marking its best monthly performance since May 2020. Gold prices fell more than 10% in March, posting the largest monthly decline since June 2013 and ending the previous 8 months upward streak. Silver prices dropped over 19% for the month, ending a 10-month winning streak and recording the worst monthly performance since 2011. Our stock pick today is Harbour BioMed, stock code 2142. Harbour BioMed is a global biopharmaceutical company focused on the research and development of innovative drugs for immune diseases, oncology, and other therapeutic areas. The group rapidly expands its innovative drug pipeline through independent R&D, collaborative development, and diversified partnership models. It has two core pillars, Harbour Therapeutics and Nona Biosciences. Harbour Therapeutics focuses on advancing a pipeline of products with transformative therapeutic potential on a global scale. Nona Biosciences, leveraging the group's strong technology platforms and professional expertise, accelerates global biotherapy innovation through an open and innovative business model, ultimately benefiting patients worldwide. In 2025, the group fully entered its 3.0 strategic phase, driven synergistically by three major growth engines, transforming Nona Biosciences into an AI-powered new infrastructure for global antibody drug discovery, establishing long-term platform-based strategic partnerships with multinational pharmaceutical companies to accelerate global expansion, and maximizing the global value of mid to late-stage assets in areas such as autoimmunity and oncology through Harbour Therapeutics. In terms of performance for the year ended December 31st, 2025, the group recorded revenue of $157.9 million, representing a year-on-year increase of 314.6%. Profit reached $92.2 million, growing 31.9 times year-on-year. Regarding global collaborations, in March 2025, the group entered into a global strategic cooperation agreement with AstraZeneca to develop next-generation multi-specific antibody therapies for immune diseases, oncology, and various other conditions. Under the terms of the agreement, AstraZeneca will receive option rights for two preclinical immunology projects and will nominate additional targets for Harbour BioMed to develop next-generation multi-specific antibody therapies. AstraZeneca may exercise these options to advance the projects into clinical development. In return, the group will receive upfront payments, near-term milestone payments, and option exercise fees for additional new projects totaling up to $175 million, as well as development and commercial milestone payments of up to $4.4 billion, plus tiered royalties based on future net sales of the products. AstraZeneca also has the option to include more projects under the collaboration within the next 5 years and may extend the agreement for another 5 years upon mutual agreement. In addition, AstraZeneca subscribed for newly issued shares representing 9.15% of the group for $105 million. To advance the collaboration products under the agreement and further joint initiatives, the group will establish an innovation center in Beijing, China, together with AstraZeneca. In June 2025, the group's wholly owned subsidiary Nona Biosciences entered into a licensing agreement with Vistara to advance the development of Vistara next-generation biologics pipeline for treating immune-mediated and autoimmune diseases, utilizing Nona's proprietary HCAP Harbour Mice technology platform. In the same month, the group also reached a global strategic cooperation with Otsuka to jointly advance the development of HBM7020 for the treatment of autoimmune diseases. In November 2025, Nona Biosciences entered into a non-exclusive licensing agreement with Pfizer to accelerate preclinical antibodies discovery for a range of potential disease indications. Under the agreement, Pfizer will gain global access to Nona Biosciences' proprietary HCAP technology platform to generate fully human heavy chain only antibodies. In return, Nona Biosciences will receive an upfront payment and is eligible for regulatory, clinical and commercial milestone payments. In December 2025, the group entered into a long-term global strategic cooperation and licensing agreement with Bristol Myers Squibb to develop next-generation multi-specific antibodies. In return, if Bristol Myers Squibb elects to advance all potential projects, the group will receive payments totaling $90 million plus up to $35 million in development and commercial milestone payments and tiered royalties. Recommended buy price $12.8, target price $14.1, stop loss level $12.1. I do not hold the above stock.